You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is Bo Polny of Gold2020Forecast.com. Welcome to the show, Bo.
Thank you. I appreciate you calling.
And at least we're in the same time zone. You're in California. Whereabouts?
I'm in Newport Beach area in California.
Just to give people some background now, Bo, you've been in the gold business long enough to have forecasted some pretty important highlights here. You called the November 2012 gold bottom within 48 hours of an interview you did with Kerry Lutz. Now, that amount was $1,130. And of course, you got the silver top at $48 back in 2011. So you're pretty good at picking these numbers. Are you expecting a low in gold again?
A low, as of right now, I would say the answer to that would be no. I believe the low for November should be the low that we've been waiting for, and I believe we should be seeing up price movement from here.
Mm-hmm. Silver.
Same thing. Silver typically bottoms after gold. So if gold bottomed in December, silver did it a month later. I'm sorry, gold bottomed in November, and then silver almost always on a cycle will bottom second. And so it bottomed 3 to 4 weeks later on the Swiss referendum, so it went down like the low 14s, and then it reversed back up on December 1st. So just that pattern of itself is another diagnostic reason where we can look at that as potentially being, a finale to the bottoms here, both for gold and for silver.
Also, could you tell us about the cycle low turn date, the one that hit on Monday?
Yeah, well, we've got some price movement on gold. We were looking for a reversal a couple weeks ago, or about 2 to 3 weeks ago in January, the very end of. The price was there at $12.50. Instead, we had an inversion on the cycle, which then the next wave formation would put us into a low yesterday into today for a final, for again a cyclical low on this wave formation from January of 1300 high.
Now, you have a PDF chart that's available for our listeners. How could people find that chart?
In the next few days, my web guy should be able to get it on my webpage for him. But in the meantime, I'm under the understanding that it might be linked to this video presentation or to this interview. But eventually, my website, they can go there in the next few days, and that's Gold 2020, so Gold2020Forecast.com, and there will be an update there dated February 24th, 2015.
Now, if people are going to take a look at this chart, what will they see and what does it mean?
What I did was something kind of fun and fascinating, combining 3 different theories. First off, I took what I'm looking at in terms of monthly cycle counts, and on that PDF dated the 24th of February, I included 2 S&P charts. The first chart, again, it's going back, the chart up is a 20-year chart on the S&P, and it does monthly count. So each candlestick represents 1 month. Looking at the cycle formations, we've got a topping pattern that occurs the last 24 months. And so if we run those patterns for 1999, we run the 24-month topping pattern again for starting 2016, and then we run the topping pattern again starting 2013. You'll notice that on the prior 2 cycles, after the 24-month topping pattern, the market started to fall apart and drop. Currently, on the third box of 24 months, there's a yellow box. What that is illustrating is we're out of time, not we, but the equity markets, the stock markets, U.S. markets are out of time. So even though the price has been rising, when there's no more time and time ends, then you have to have a reversal in the opposite direction. And so, could there be another few days, a few more weeks? Anything's possible, but on the monthly charts, on the monthly counts, the time has expired. So the energy for the move to the upside is quickly running out. And so I titled my presentation, the 7-year stock market cycle that is screaming get out now. And then what I did is I correlated that with two other interesting facts. The other one was a recent interview that I had listened to on Silver Doctors, and there's a link there. But basically it was by Rabbi Jonathan Cahn, and he, interestingly enough, talks about also a 7-year economic crash cycle. And it's definitely worth a listen to, but he covers a bunch of real topics in major detail. But he's foreseeing similar price movement for the equity markets. Basically, a big drop, a big fall for the equity markets. And then lastly, what I did was I combined that. The third topic would have been I took the famous W.D. Gann. If people don't know who he is, but he'd made some truly amazing calls, and his work is really fascinating on how he's discovered market movements. And in a what is it here? It's a financial timetable from 1909. Specifically, he talks about the year 2015, so this year, as being a panic year. So again, so we got the topic for today would be the coming panic of 2015.
And of course, the way to look after yourself is not to panic when everybody else is.
Well, right. So I once read somebody wrote, it's better to be out a day early, or better just be out early, period, than one day late. So if you're in the equity markets, whether it's a day, a week, or a month, whatever it is, it's just better to be out early than even one day late, because one day late could be very painful.
Now, of course, this is still contrary to what I call the yell and sellers that you see quite often on the financial television networks, telling people, don't worry, we're in special times, the central banks will protect our butts. What do you have to say about people like that?
Well, honestly, I don't watch a lot of TV in the news, because that's just nothing but just distraction. I just look at I look at the charts. What I did is I illustrated here, I think, pretty much in black and white. You can look at this chart, and then what I did was on the second page, I took the S&P and I laid that chart up against I ran the chart relative the U.S. dollar, and the pattern that comes out is really quite shocking and scary, because it really illustrates what's potentially going to happen. So so anybody calling for continued don't worry, be happy, it's those people are playing golf in a hurricane, and eventually you're going to lose that trade. So I've just betting against the cycle that indicates price action is going to be reversing here shortly is, in my opinion, quite dangerous, regardless of what anybody says.
We'll have more with Bo Polny right after this.
More and more people are looking to the internet for intelligent, riveting, and thought-provoking interviews. To advertise on the Goddard Report and TalkDigitalNetwork.com, call 604-699-8600, 604-699-8600.
Welcome back. We're speaking to Bo Polny of Gold2020Forecast.com. Bo, we're saying 2015 could be the year of panic. You talk about a special kind of cycle that might tell us a bit about it. Tell us the name of the cycle and how it works.
I specifically don't have a name for it, but W.D. Gann called it the panic cycle, and Jonathan Cahn called it a Shemitah. So both of which, it doesn't matter what you call it. The point is that the direction would be down for the year 2015 for the equity markets.
Uh-huh. And how far back was this forecast made?
Well, I've run my charts back 252 years. I think Jonathan Cahn runs his back even further to overall cycles, maybe further. So, and I again don't know how far W.D. Gann took his cycles, but my crash cycle that I'm looking at, or the panic and then into the crash cycle for starting in 2015, I've taken back to the year. I'm not sure the year, but it was specifically back 252 years.
And I'm always amazed at how accurate that these cycles charts are, and how, as humans, for some reason, we like to attribute certain things happening for some kind of reason, but these charts tell us it's time, not specific reason that affects it.
Well, that's a great way of illustrating it, is eventually when enough time goes by, then there become reasons for things to happen, right? So inherently, as a global collective, or, when you look at it as a global populace, a cycle, it's predictable, but the events are lacking until time runs out. And then when time runs out, anybody looking at the world right now, look at the events going on in the world. There's not one, but you could probably mention 30 or 40 or 50. You can keep going on about the reasons for there to be financial problems. So all that's lacking is for them that they've not gotten triggered yet.
Do you still see a new high for gold this year?
I'm still forecasting and still believe gold will have a really good year before year end. Last year I made 2 forecasts, but which of half came true. We were talking in the forecast and in the interview that I made in May, and the prediction was that the equity markets were not going to crash and would continue making higher highs for the year 2014. That actually happened. And then the second forecast was gold was supposed to get up to $2,000. So that hasn't happened yet. Going back hindsight and realizing, redoing the month counts and the quarterly counts, I mainly do, when I look at gold, I look at it from the day counts, but also look at it on quarterlies. And looking at it from the quarterly perspective, hindsight, nothing ultimately changed. The cycle was extended, and so we're just looking at higher price action into this year still to fulfill and also complete the cycle that was forecast for 2014.
Are you more bullish on silver or gold, and why?
Again, the trade itself is on silver. I wrote in the update as well. Yesterday, checking the price action relative gold and silver, the ratio was at 70. Yesterday being the 23rd of February. The price action and the ratio at that point in time was 73.4. That ratio of itself is extremely high. Anytime you have a ratio in the 70s, the trade's always on silver because you want to lower that ratio down to something more reasonable in the 20 or 30s, 40s. But ultimately, the ratio is somewhere in the 15s. But that's years out, I still believe, before we even see those kind of ratios. So the answer to your question would be silver as a trade, just because of the high ratio in the 70s right now. And then once the ratio gets smaller, then I would never sell sell specifically precious metals. I would just swap the silver and then purchase gold.
Oh, it's a simple plan, but very effective.
Yeah, then you'll end up holding more gold than you could right now.
Bo, thanks a lot for chatting with us.
My pleasure. Thank you so much for calling.
My guest has been Bo Polny of Gold2020Forecast.com. You're listening to HowStreet.com radio. Find us on Twitter or Talk Digital Net. Our YouTube channel is Talk Digital Network. That's also where you'll find the PDF for Bo's charts. Comments about the show can be sent to info@HowStreet.com. I'm Jim Goddard.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.